Yes, ma'am. I'll make sure.
Okay, awesome. So again, welcome to our ABLE account workshop. Thank you so much for being with us today. Darryl Wright, our guest speaker, has a passion to help others achieve their personal development and financial goals. His motto is, if you can't make a dime, make a difference. Mr. Wright is a retired U.S. Army Sergeant First Class and the Regional Vice President of Primerica. He is a graduate of the Hawaii Pacific University with a degree in supervisory leadership. He's also a distinguished Toastmaster and a volunteer presenter at the first-time homebuyer class at the EOA of Savannah. Mr. Wright regularly speaks about finances, leadership, and communication at the engagements of professional and civic organizations. Today, he's going to be speaking to us about ABLE savings accounts and financial basics. So let's welcome Mr. Darryl Wright.
All right. Thank you, Denise, for such an eloquent opening there. Wow, I should have wrote that myself and gave it to you. I couldn't have done it any better. Hello, everybody. Hope everybody's doing well on this beautiful Thursday here in Savannah, Georgia. And I want to talk to you guys about the ABLE accounts. Am I able to share my screen?
Yeah, you shouldn't have any trouble sharing.
Okay. Let me see. Okay.
There we go.
There we go. Let me get this slideshow. All right. So ABLE accounts, ABLE America, from Capital Group American Funds. They are tax advantage savings plans for individuals with disabilities. This is the only company that offers such an account or a fund for people with disabilities. And I'm happy to share that because people with disabilities, their families, they need money set aside to help them out as well. So I'm glad to share this with you, and I'm glad that this company does something about that. You know, this life with disabilities can be challenging. It has its own challenges and rewards, and that's why ABLE America was set up to meet those needs and help you pursue your goals. It's a way to build savings through mutual funds, which we'll talk about in a little bit. Now, who is eligible for an ABLE account? Can everybody see the screen? This is just me. Okay.
Yeah, we're seeing it, and it's going from screen to screen, so it looks good. There are several people, of course, on the in the workshop that aren't able to see the screen at all. So be sure if there's anything really relevant that you describe what's on the screen for us, Daryl, if you don't mind.
Okay. Thank you for telling me that. Appreciate that.
No problem. Yep. Thank you.
So who's eligible for an ABLE account? ABLE accounts are available to U.S. citizens and permanent residents who can legally own securities. That means you're at least 18 years old, including individuals who are blind or disabled from a condition that began prior to age 26. Now, those who meet the age requirement and may be eligible for SSI or SSDI benefits because of their disability, they're also eligible, and individuals with a written signed diagnosis from a licensed physician. So hopefully that covers everybody as far as the eligibility portion of who can have an ABLE account. So who owns the account? The beneficiary. The person who the account is for is actually the owner of the account. And who can contribute to the account? Well, parents, grandparents, extended family, friends, beneficiaries, charities, or trusts. So we just gone over who's eligible for the account, who owns the account, and who can contribute to the account. Are there any questions about that? I want to make this too complicated, but it's pretty straightforward. So with the ABLE account, a person is able to contribute up to $15,000 per calendar year. Okay. Now, before this legislation was passed, they can only have $2,000 in a savings account to qualify for needs-based government programs. But now with ABLE, people are able to have $15,000 per calendar year, which is a huge difference there. $15,000 can go a little bit further than $2,000. They can have up to $100,000 in the account without the amount being counted against the $2,000 limit on personal assets to qualify for supplemental security income, or SSI. The savings grow free from federal taxes and may be free from state tax if used for qualified disability expenses. Tax advantage treatment applies to savings used for qualified disability expenses. Okay, so it's going to go for you federally tax-free, and in most cases, going to be state tax-free. Money can be withdrawn tax-free to pay for qualified disability expenses. Now, if withdrawals are used for purposes other than qualified disability expenses, the earnings will be subject to a 10% federal tax penalty in addition to federal and, if applicable, state income tax. All right, come on screen. All right, not too far. All right, so now we're going to talk about the different things that can be used for the ABLE account. Everybody can see the screen. So it can be used for basic living expenses, health and wellness, housing, financial management, transportation, education and training, employment training, assistive technology, legal fees, and professional services. I think that pretty much covers the gamut of what you can use this money for and still be used as a qualified expense. You give your savings a tax-free advantage, and this diagram below shows, imagine if you saved $100 a month in a tax-free ABLE account. Over time, you would have a higher balance than if you invested the same amount in a taxable account, assuming no withdrawals were taken. So in 15 years, if you had money in $100 a month for 15 years, assuming a 6% rate of return in a taxable account, you'd accumulate $25,738. But in an ABLE account, because there's no taxes assessed to the account, it'd be $29,000. So it's a difference of about almost $3,500. And over 25 years, it'd be a difference of about $14,000 because of the tax advantage that you would have being in an ABLE account. So there's a great benefit to be in an ABLE account because of the tax situation, and you can pull it out and use it tax-free. Now, people living with disabilities may face extra costs of living, often totaling several thousands of dollars more per year. These costs add up, creating a significant financial burden on households. So this is a way, because, and I'm sure you folks know that it just costs more to when you have a disability or something that you're dealing with. So having funds to help offset those costs can be really beneficial. And that's why the ABLE account was set up. So we've got different investment strategies that we can use for the ABLE account. One of them is a growth and income account. In this example right here, it says a car accident in his teens left Marco with lasting physical complications. Several years ago, his financial professional suggested an ABLE account to help meet his financial goals. Today, Marco invests his assets in growth and income portfolios, taking tax-free withdrawals to pay for his transportation and assistive technology needs now, while also saving for the future. So a person can still have a relatively normal life with the ABLE account and still pay for their day-to-day needs while saving for the future. It's really important to save for the future, okay? People that don't have disabilities don't save for the future. And this is a message that I try to share with everybody, that when you learn to save money, money saves you. So we want to make sure that everyone has an opportunity to save for the future. That's what the ABLE account allows folks to do. And another example here, we have, and this is a preservation and income. This lady's preparing for a rainy day. So Sandy was diagnosed with autism as a child. Now in her 20s, she lives independently and works part-time, relying on government need-based programs for the rest of her income. Although Sandy has put most of her ABLE investments in growth funds, she also asked her financial professional for ideas on how to preserve her assets during market declines, because the market does have its ups and downs, and help pay emergency expenses. After discussing her options, she decided to make additional investments in preservation and income funds. So understanding that the market does have its ups and downs, when you're investing for the long haul, we account for the ups and downs because time will help make up for it. But for the short term, for the interim, you may want to have some of your funds in something that is that's not exposed to the ups and downs in the market. And so ABLE offers accounts for people who don't want to ride the wave or the roller coaster of the stock market going up and down. Now, we're just showing the investments that are aligned with your goals. So like we talked about, they have goals where you can build wealth. Those are normally growth oriented. So if a person says, I want to put some money in here so I can have for when I get older, when I get towards retirement, those are growth oriented, long-term growth of capital. And we have funds, American Funds already has funds designated for that. If you want to spend wealth, meaning, okay, I want to save, but I also want to make sure my money's growing at the same time, we call that growth and income, long-term growth of capital and income. And so we have funds situated for that. And then for conserving wealth or preservation and income, American Funds has funds situated for that. So whatever your desire or need or your risk tolerance is, there is a fund that's designed to help meet the needs that you have. Because anytime I talk to people about investments, it's always based upon their time frame and their risk tolerance. The same applies here. There's nothing different. We just already have it packaged for you based upon what your risk tolerance is and what is your time frame. We have a fund that's going to be available for you. So ABLE, like I said, it's the nation's only advisor-sold plan that gives you access to professional advice and helps you build a comprehensive plan. Wide-ranging investment options allow you to put more money to work to pursue your goals. Broadly diversified objective-based investments allow you to select portfolios tailored to your goals and needs. And that's what I was talking to you about earlier. And you get a chance to work with a financial professional such as myself to build a better life with ABLE America. So that's it on the ABLE. It's not a whole lot of moving parts, but I want you to know, who's eligible, who can contribute, how much you contribute, how it works, what can you use the funds for, and then what type of investments are available for you in the ABLE account. Are there any questions, comments about what we just shared?
I don't see anybody with their hand raised or in the chat. Was somebody starting to talk?
Are there any withdrawal limits, or you can withdraw as much as you need?
You can withdraw as much as you need. Yes, ma'am.
Yes, good afternoon. This is Sabrina. I had a question. Are you able to save, just say, for instance, you looking to buy a house. Is that something that you're able to do on that account as well? I know you said housing, but does it mean?
It said housing. And so if a person with disabilities looking to, whether it's paying for rent or paying for a mortgage, that would be considered housing.
Okay.
So, yeah, I mean, I'd rather be purchasing a house than paying rent, but, it can be used for either or, as long as it's for that person that the account is set up for.
So each time that you withdraw from the account, do you have to provide documents and I guess paperwork stating what you're doing with the money, receipts?
Probably not. They normally don't check that, but but in case they do, or in case you get audited or something, you want to make sure that you can show the paper trail of, hey, we pulled out, $10,000 and we used it for, down payment of the house. We used it for some assistive technology. You just have to be able to show that the money was used for a qualified expense.
Okay. Thank you for answering that.
You're welcome.
Daryl, this is Calvin Tinley. How do you do?
Hey, good, Calvin Tinley. How about yourself?
I'm okay. What I was wanting to ask, is this a limited or a fixed time that you have to leave the assets in the account before you can access it, or is it a frozen account for 15 years?
No, I mean, you can leave it. There's no time limit on that. So like I
Right.
said, we've got funds we've got accounts that are set up for growth, and that's normally a longer term projection. If you've got money put in here for growth and you say, hey, I'm using it for retirement, I'm using it for something, then that's going to be a longer term. But you also have preservation and income where you can use it a little bit quicker if you needed to. So it's based upon you. There's no time limits on when you can or cannot pull the money out.
That's the question. Thank you.
You're welcome, sir.
Is there a certain amount that you need to get started with your account?
I believe the minimum of about 100. If you're going to do a monthly contribution, it's normally about $50 to $100 a month. But the maximum you can put in any calendar year is $10,000.
Okay. So to get started with an account, you would have to meet at least $100, is what you're saying?
Yeah, I think theirs is $100 a month if you're going to do a monthly contribution. Yes, ma'am.
Okay.
And like it was stated, there's other people in the family and the community that can also contribute to this account. It's a 529, which is a college savings account, is set up along the same lines, because this is in the line with the 529, where if you were to set up a college account, 529 account for your child, you could have grandparents, family, friends. On birthdays, you could say, hey, instead of giving little Johnny a truck, why don't you put that $25, $50 in his college fund? Well, the same thing can happen here. You can have, hey, instead of giving this person maybe a birthday gift or a Christmas gift, why don't you contribute to their Able America account? So it's a way that you can get other people involved in contributing to the account for the beneficiary.
If someone's on SSI, would they have to get prior approval to set up an ABLE account?
No, they don't, because they're eligible based upon the eligibility. Where's that page at? Let me go back. Right. So on the, let me just get to that point and read that for you. So who is eligible? ABLE accounts are available to U.S. citizens and permanent residents who can legally own securities, including individuals who are blind or disabled from a condition that began prior to age 26, those who meet the age requirement and may be eligible for SSI or SSDI benefits because of their disability. So I guess there's an age requirement in people that are eligible. They also are eligible for this account. And individuals with a written signed diagnosis from a licensed physician. Denise, did I answer your question?
Yes, you did. Thank you.
Okay. Any other questions?
Yeah.
Go ahead. Yes, ma'am.
Okay. My name is Verily Mitchell. How you doing, sir?
I'm doing good, Ms. Mitchell. How about you?
Okay. Okay. So she did ask the question, do we have to let authorities know? Okay, you answered that. Okay, when you say age 26, are there stipulations based on the age? Because I wasn't diagnosed till my early 50s.
You weren't diagnosed with, and 26 dealt with who are blind or disabled from a condition that began prior to age 26. So you said you weren't diagnosed until you were 50s?
Yeah.
Is that what you said?
Yes.
Okay. Well, you could, and one of the other things is individuals with a written signed diagnosis from a licensed physician. That can overcome that 26 for you.
Okay. Okay.
Okay.
Yeah, because my heart doctor told me that I would never be able to work again, but that is not absolute. I feel restored, like I've been resurrected or something.
You sound pretty healthy and strong to me.
Well, thank you. I'm getting better. It's still one day at a time.
One day at a time. That's all of us. We're all the one day at a time, folks. So,
Okay.
okay.
Okay. So with the you mentioned something about $100,000 and $10,000. So other people can help you with these funds.
Yes, ma'am. Yes. So all who can contribute are parents, grandparents, extended family, friends, beneficiary, charity, or trust. So
Okay.
that's that. I'm sure everybody you know can fall into. I mean, friends is a pretty broad category. Extended family.
Okay. Okay.
Yeah. So it's $15,000 per calendar year, and up to $100,000 total.
Okay. Total. Okay, got it.
Mhm.
Okay,
Got it?
thank you.
You're welcome.
Well, when you go and talk about the age and being, like she said, she was in her 50s, would it be proof that the fact that you're receiving SSI or SSDI as far as a award letter, would that be a document that they could use?
Right. Yeah, because I think it says those who meet the age requirement may be eligible for SSI or SSDI benefits because of their disability. Correct. So I guess the
Yeah.
award letter would
Suffice.
be the proof.
Okay.
Yeah.
I'm liking what you're saying right now.
You like
I
what I'm saying?
know,
Yes,
right?
yes,
I
I'm liking what you're
know.
saying.
All right.
So you
Yeah. I
think-
mean,
So my understanding is if you have your award letter and just say you want to start with maybe $100, that's something that's doable. And then you just need to make sure you're adding to that account each month.
right. Yeah. We
But-
can definitely talk about that a little bit more. I'm just to kind of give you some exact things, but you definitely can.
Okay.
Yeah, and then hopefully get some other folks in your community to help contribute to that as well.
Okay.
I'm sorry, go ahead, Sabrina.
Go ahead. I'm sorry. Go.
This is Rachel Black. I have a question. I'm sorry if you already covered it, but
No worries.
I actually have a cousin who is she's special needs. She has an intellectual disorder and has a guardian. Can the guardian still establish an ABLE account for her?
Sure, but because she will be the beneficiary of the account, so that's who
Yes.
will own the account is the beneficiary. Somebody else will definitely have to set it up. As normally, if it's not a parent, it's going to be a guardian.
Okay, because she's because we're actually that's a big deal though, having that extra money aside for a rainy day and for
Yes, ma'am.
those needs, especially when you have a fixed income
Mm-hmm.
and the cost of living is so high right now. But I will recommend it to her guardian and maybe they can do something like this.
Okay, definitely. I'll have my contact information up after the next presentation. You'll be able to get in contact with me if you want to sit down and talk about that, or they can call me if they want further information.
Thank you, sir.
You're welcome, ma'am.
One more thing, Daryl.
Yes, sir.
Is the ABLE account covered under FDIC insurance?
No, it's not.
No, it's not.
This is an investment. No, this is an investment account.
Investment account. Okay.
Yes, sir.
That's the one scroll that was in my back. Thank you.
Okay. You're welcome.
Also, with an investment account, there's no debit cards or anything associated. Like you go and pull it out and use it as like a savings or checking account.
No. What the way you probably be able to receive the money, we probably could set it up where your checking account is attached to the account and.
Real well. Okay.
Yes, ma'am. Yeah. Yes. I
Okay.
mean, but if somebody was to give you $100,000, which the max is, and you need to live off that, then you could actually, say, hey, every month I need, $1,500 or $2,000. If you could set it up that way as well.
Okay.
Great questions. You're stretching me here, and I appreciate that. So
Are
I've
there
got
any-
another presentation. It's going to be more kind of financially based, a little bit about who I am, what we do, and some of the concepts that we share about basic finances. So if there aren't any more questions pertaining to this, I'll transition to that. Is that all the questions?
I had a couple of questions come in. Someone that is
Okay.
on this workshop that unfortunately they're having some technical issues, which we all know happens sometimes with
Right.
Zoom, and he's not able to unmute himself. So I have two questions from this individual who wanted to know what the interest rate was on the account itself. Do you know that? Is it variable or?
It's variable because it's invested in the market. So you have some of the investments. Let me get to that page. So the ones that are growth oriented, they're going to be the ones that over time are going to be a better rate of return on the growth, and then the growth in income, and then the preservation and income fund. They're not really meant to grow a lot, but they're meant to preserve your money and be there to provide an income for you. So
Gotcha.
there's not a fixed rate because they're investment accounts.
Okay, I expected as much. The next question this individual had was, who offers the Able America account? Where is that available?
That's through Capital Group, American Funds. These folks that are actually here, Capital Group, American Funds, they're the ones that offer this account. And I'm a representative of this organization, so that I'm the local guy that can offer this to people who are interested in getting this account.
Oh, fantastic. Good. We can go straight to the source then. That's wonderful.
Right to the source. Yes,
Very straight
ma'am.
to the source. There is one more question in the chat. It says, are there any monthly fees for the account?
No, the fees are more of an annual fee, and it's usually directed from the account, depending upon which account that you choose. They're normally a little bit less than 1%. American Funds, Capital Group, they're pretty good about their fees there, but that's just the management fees for those folks that manage the investments and make the choices that are going to be helping your money to grow. So yeah, once we get into, if somebody wants to sit down and look at a particular one, then we could actually look at the particular fees and the fee structure associated with that particular account or investment. Did I answer that good enough?
Yep, she said thank you in the chat. So it sounds great. Thanks, Daryl.
Okay, you're welcome. You're welcome. Is that all the questions? Because I don't think I have any more answers. All right, that's it. And you can always ask other questions. Let me go to the next presentation. This is a this is more just kind of give you a little bit of background about who I am and the company I represent. It's Primerica. We're the largest independent financial services company in North America, have over 130,000 licensed representatives. We're listed on the New York Stock Exchange. So people want to know, is this guy legit? Yes, I am. We're under the ticker symbol of PRI. We've been in business since 1977. Got a long track record here. Got 5.5 million people's lives insured and approximately 2.6 million investment clients. Our headquarters is in Duluth, Georgia. Big deal up there. Over 2,000 dedicated home office employees that support us and our clients. Our goal at Primerica is to be a one-stop shop financial supermarket with home and Zoom delivery, because since the pandemic, we have now adapted our business to where we can actually do business through Zoom, which has really helped out a lot. These are some of the companies that we represent. We represent from annuity companies to managed accounts to mutual funds, legal protection service, home and auto companies. We have a senior healthcare that through a company called Easy Medicare, and that's a company for folks who are 65 and looking, because when you go to apply for Medicare and things of that nature, it's really complicated, and these folks can help simplify that for you. We're getting into we're doing loans now through Rocket Mortgage. We're going to start doing loans here in Georgia in July. We have our life insurance division, and we have our 401k plans for people who may have their own business that might want to start a retirement plan for them and their employees. That's just a rundown of what we do and what we offer. Our mission statement is to help families earn more income and become properly protected, debt-free, and financially independent. You know, to me, that's a statement that I can get up every morning knowing that there's some families out there that need some help, that need a game plan. And I'm pretty excited about that. Now, the question is, why are people having so many financial challenges? Most people today don't get a financial education. And April is Financial Literacy Month. So it's great that we're doing this in April, because financial education is something, financial literacy is something that is woefully lacking in a lot of Americans out there. So we want to help bridge that gap from not knowing to getting people on the track financially. And once you get an education, then you need a financial game plan. You need to know what to do with the monies you have. And if you have a goal in mind, you want to have a game plan and have a financial coach. Darryl Wright's a financial coach. I like to help people. I'm not your boss. I want to help coach you to financial independence. So this results in serious challenges for Main Street families, because they don't have a financial education, they don't have a financial game plan, and they don't have a financial coach. Serious problems for people out here in just Main Street America. And that's pretty much our target market. Now, some of the financial challenges that we run across out here is that statistics show, these are statistics here, that 74% of workers report living paycheck to paycheck. During the pandemic, you know, that really got illuminated, especially when people started losing jobs and had to transition from the workplace to home. That wasn't a very easy process. Half of Americans say they worry they'll run out of money in retirement. Most people don't know how much money they need to retire, and they don't figure that out until they're at retirement. That's something that should be figured out 15, 20, 25 years prior to getting to retirement. Then you have the average American has, you know, over $90,000 in total consumer debt. Consumer debt. That's a lot of debt out there that we want to try to help Americans eliminate. 60 million households in the U.S. are either underinsured or uninsured. You know, with the average life insurance coverage gap of about 200,000. There's a statistic that say most people say if the breadwinner was to die today, that family would be out of money in 30 days to 90 days. They'd be just out of money. So we need to make sure we do something about that. And then 30% of Americans say they have less than $25,000 in savings and investment put away for retirement. So these are the numbers, these are the facts. It's woefully disturbing out there, but we're trying to do something about that with our company. And that's why I like to get out here and talk to folks about these things. Now, these are real and very serious problems. And there aren't very many companies out there trying to focus on Main Street families to help them solve their problems. Our focus at Primerica is to help Main Street families, the everyday folks that are out there making $30,000 to $120,000, $150,000. That's kind of the Main Street of America. That's our target market. We offer something called a financial needs analysis, because here's what we know. People don't plan to fail. They just fail to plan. I have never in my 27 years of doing this ran across somebody that just said, Daryl, I just want to be a financial failure. I don't want to have any money. I want to be broke, busted, and disgusted. Nobody ever says that. And it happens to a lot of people. The reason being is that people don't plan to fail. They just fail to plan. So what our solution is what we call a financial needs analysis, or an F&A. It's a customized, confidential, and complimentary program that helps you achieve your goals and dreams. I didn't want to do that. Hold on a second. What it is, it's a GPS. It's a financial GPS. What it does, it takes a snapshot of where you are right now, and it gives you a roadmap to get to where you want to be. That's what you need. In order to get to a destination, you have to know where you are, and you have to know where you want to go. Once we determine where you are, and you tell us where you want to go, then we develop a game plan to help you get there. Now I'm going to talk about some concepts. The first one is, do you know your financial independence number? And like most people, they'll tell me, Daryl, I've never heard of a FIN number. What is a FIN number? I've never even heard of that. They don't teach that in school. Well, Daryl Wright's going to teach you today now. Your FIN is the amount of money you'll need to accumulate so that someday you can live off of that money for the rest of your life and never have to go back to work. Now, most people when they hear that say, man, that's what I want right there, but they haven't figured that out. So I'm going to show you an example of what a FIN number looks like. Let's say you came to me and you said, Daryl, I want to retire in 30 years and I want to have an income of $30,000 a year when I retire in 30 years. I said, okay. So 30 years from now, after we factor in inflation, and we just use 3%. If you follow in the news, you know inflation is up 8.5%. That's extremely high. We haven't had inflation that high probably since the 70s. But we just, before this, 3% was about the norm. So now it's about 8.5%. But just looking at the 3% example, if you look at that, if you factor 3% inflation 30 years from now, it'll take $73,000 a year to spend like $30,000 does today. Okay, let me say that again. If you say you want to retire in 30 years with a $30,000 a year income, I'm going to say, okay, we had to factor in inflation because prices and things go up. It's going to take $73,000 a year to then 30 years from now to spend like $30,000 does today. So you say, okay, Daryl, okay, so how much do I need? Well, once we do the numbers, this person's financial independence number is $1,080,000. That's how much they need to achieve this $73,000 a year in 30 years. You say, okay, so how do I get there? To get there, you'd have to invest $585 per month for 30 years, averaging a 9% rate of return to get that $1,080,000. Okay, so most people say, wow, you know, it's eye-opening when you actually put your numbers in here to see how much you actually need. But it's important to know that, so at least you know what you're shooting for. Most people I talk to, they have a 401k, they've got some money in a retirement account. Most people assume that just having a retirement account will take care of them. Well, if you're not funding that properly, if it's not properly allocated, it probably won't. So we definitely need to make sure that people are doing the right things with their finances. The next thing is there's 3 accounts that we suggest every family have, every person need. And to have a complete savings program, these are the 3 basic accounts that you need. The first account is an emergency fund. An emergency fund is defined as 3 to 6 months worth of expenses set aside in a savings and a money market in a safe account. So if you need that money, it's there for you. And during the pandemic, people's lack of emergency funds, when they had to transition from work to home and there was no money that came with that, not having an emergency fund, that really hurt a lot of people. So we've always stressed emergency funds. During the pandemic, it really highlighted that. So when I talk to people, the first thing I ask them is, do you at least have $1,000 saved? You'd be surprised. The statistics say maybe 40 to 50% of people that work that have jobs don't have $1,000 set aside. And you see, most emergencies are going to be probably within $1,000. So what I suggest, if a person doesn't have at least $1,000 set aside, that be your first goal. Once you've got $1,000 set aside, then let's work on the 3 to 6 months worth of expenses set aside. Because there's something about when you have money, when you have something set aside, you feel a little better. At least I know I do. When you learn to save money, money can save you. The second account is called a short-term savings. If you're looking to purchase a home in the next 18 to 24 months, or purchase a car, do something, a purchase like that, or down payment for a home, down payment for a car, you've got at least 2 years, 2.5 years. Hey, this is another account separate from your emergency fund where you save money towards those goals. And then the third account is your long-term savings or your wealth building account. This is for if you have small children for their college education, or your retirement account, your 401ks, 403bs, IRAs, this account. So each one of these accounts has a mission, and the emergency fund mission is not the same as a long-term savings. So you want to make sure you have these different accounts set up. So when you have an emergency fund, you're not going to your long-term savings and borrowing money from there. I see a lot of people, they have a 401k, they have an emergency. Because they don't have an emergency fund, now they're taking money out of their 401k. So what in effect that person is doing, they're robbing their future self today. And you don't want to rob your future self, because when you get to be 60, 65, you say, why did I do that back at age 40? I could have done without that. So having the 3 basic accounts set up keeps you on track to meeting your financial goals. Another concept we teach is called bypass the middleman. We want you to become an owner and not a loaner of your money. Here's how this normally works. We normally give our monies to the banks, credit unions, and insurance companies, and they've given us historically low rates of return. If anyone has a savings account at a bank, the savings accounts are usually 0 point something. Even with inflation going up, I would assume that the investments or the savings rate would go up, but they haven't gone up yet. So we say, instead of giving your money to these guys and them paying you a little bit of money, don't invest your money with the bank, but invest your money like the bank invests. The bank invests in the global economy. So we want to teach you how to invest your money so that you can make a higher rate of return on your money. Not saying that you shouldn't have any money in the bank, because definitely you should. But for the money that's your shorter term and your longer term money, you want a chance at a better rate of return. You're not going to be able to get that in the bank. That's where investing comes in. The rule of 72. When I joined this business 27 years ago, this was the first rule that I learned, because this is a rule I think everybody should know. What the rule of 72 states is that whatever your interest rate is, you divide that number into 72, and it will tell you approximately the number of years it will take for your money to double. A powerful rule here. So let's say you're getting 3% on your money, and you've got $10,000. According to the rule of 72, you take that 3%, divide it into 72, and that equals 24. So at 3%, your money doubles every 24 years. So in this example, you start with 10,000, 24 years, you have 20,000, another 24 years, you have 40,000. Okay. Now, if you don't know there's anything better out there, you might think that's pretty good. This is where education comes in. Let's say now you shop around and somebody says, well, ma'am, sir, I can give you 6%. So you figure if I'm doubling my interest rate, instead of having 40,000, I should have 80,000. To me, that was a logical thought process. But when you take 6 goes into 72 12 times. So at 6%, that money doubles every 12 years. So that $10,000 over that same period of time, it's not double the 40, it's 4 times the 40. It's 160,000. That's a whole lot better. And if you're really sharp And you say, you know what, I'm not going to go to the banks or the credit unions. I'm going to go see a guy like Darryl Wright so we can invest this money. And let's see if we can average about 12%. 12 goes into 72 6 times. So that same one-time investment at 10,000 over 48 years, drum roll, is $2.5 million. That's a huge difference. And most people, they settle for 3% because they don't know they can do 6 or 12. They don't know that there's opportunities out here. You see, somebody asked earlier if the money was, we talked about Fdic insured. So when you get Fdic insured, they're going to ensure that you don't lose anything, but you're not going to hardly make anything either. So the 3% could be Fdic insured. The 12% is invested in the market. So do you have a chance of losing money? You sure do, but you got a better chance of doing a whole lot better investing in solid companies and funds than you do taking the Fdic insured route. So here's the questions. How do you win a game if you don't know the rules? If you don't know the rule of 72, if you don't know that you can do better, how can you win at this money game? And that's part of financial literacy and education. Second, who would benefit from knowing this rule? In my humble opinion, everybody benefits from this. Every consumer can benefit from this. And shouldn't we have learned this rule in school? I think we should have. I don't know why. This is a pretty simple rule. I can teach it to you. I'm not the smartest guy in the world, but this is not a hard rule to learn. This is something that should have been shared sometime in school. And then the last thing, without introducing a guy like me to your friends and family, how would they learn the rule of 72? My goal is to make sure everybody understands this, because when I understood this rule, it changed the way I thought about money. It changed the way I managed my money, because I understood there was another way. See, before I didn't know there was an option. 3% was all I knew. The bank, I was brought up with the bank. I wasn't brought up in a family that knew about investing in mutual funds and ETFs and all the different things that are out there. But now that I know, as the saying goes, when you know better, you can do better. So now everybody in here, you know better. So I want you to do better. Here's the old adage of pay yourself first. You should always pay yourself first. Pay yourself first. You should be at the front of the line. Me personally, with my Christian beliefs, I believe in tithing and then, hey, paying myself. All right. So in this example right here, if you were saving $200 a month at a 9% rate of return for over 40 years, during the working years, look at 25 to 65 being the working years. All right. So if you start at age 25, doing this, you would accumulate $943,280. $200 a month, 9%, 40 years. Pretty good. But let's say you said, you know what? I've got some stuff going on at 25. I'm going to wait until I turn 26. Okay. That's only 1 year, and that's only $2,400, because you would have spent, $200 a month, 2 years, you'd have $2,400 that you would have spent into this plan. By waiting 1 year, that $2,400 cost you. Look what that cost you. $83,200. Let's say you waited 5 years. That's $12,000. That $12,000 ended up costing you. Now you would have had $592,000. Let me not minimize that, but it cost you $350,000. $12,000 cost me $350,000. You have to think about that. And if you waited 15 years, a lot of people say, well, I'm gonna wait till I turn 40 and I have a good job and all yada, yada, yada. By doing that, it's gonna cost you $717,380. Now you still come up with $225,000, but what could you have had? See, that's the key. What could you have had? Now, here's the other question. Who are people hurting if they wait? And there's all kind of reasons that we cannot do something. We think of all kind of reasons. A friend of mine told me that the largest nation in the world, I wish this was alive. I mean, we could look at your face and talk to you, but the largest nation in the world, who knows what the largest nation in the world is? Somebody take a gander. James Whitehead, I know you know. Well, let me tell you, the
He might
largest
have-
nation.
He might have been
Huh?
able to unmute. He's the one that was having trouble unmuting.
Oh,
himself,
he
so
was? Okay,
yeah.
okay.
He probably
That's my-
wants to respond, but he's
Oh,
not
yeah,
able to,
that's my buddy
unfortunately.
there. I know
Yeah.
James, he's a good guy. But the largest nation in the world is procrastination. It has the most people because we procrastinate. I'll wait till my kids get grown. I'll wait till I get married. I'll wait till I get divorced. We always wait. I'll wait for my income tax. I'll wait, and procrastination kills us all the time. So do not procrastinate. Do something now. Now, debt is a cancer that is stopping a lot of folks from reaching their goals and dreams. We believe in something called debt stacking. In this example right here, we have a person that's age 35. They have a retail card that they pay $220 a month on. They have a credit card, number 2, that they pay $353. They have a car loan, they're paying $551. They have another credit card, they're paying $303, and they have a mortgage that they're paying $1293. So their monthly outlay for debt is $2720. Okay? What we believe in is that plan B, something called debt stacking. So let's say the person has paid off their retail card of $220. Most people that I know, once they pay off a bill, they celebrate. They go celebrate by creating another bill. But if you're serious about getting out of debt and you were already paying that $220 towards that bill, you know what? I need to double down. So what you would do is you take that $220 and you apply it to that second credit card where you're paying $353. Now you're paying $573. You're paying the other amount just like they were, but now you've doubled up. So you're attacking one bill at a time. Most people, they'll put, $20 here, $50 here, $50, they spread it out. In order for this to really work, you need to target, you need to laser beam focus all of your extra resources on one bill at a time. And once that bill is paid off, you take all that money and apply it to the next. So in our example here, once that credit card number 2 is paid off, we take that $573 and add it to that car loan of $551. It's $1124. Once that's paid off, we put it in the other credit card, then we put it to that mortgage, and guess what? We're out of debt. So if you did not use debt stacking and you just went on and paid it off the regular way, it would take 23 years for this person to pay off their debt, assuming they didn't incur any other debt. They would be age 58, and it would cost them in interest $214,442. Using the debt stacking method, the debt's paid off in 9 years, 14 years sooner, and they would have avoided $130,643 in interest avoided. Now, if they continue to invest that $2720 that they were paying to other people, see, a lot of times it's how you look at things. Now, the retail card, the credit card, the car loan, that's just a business trend. They don't care about you. But that's your money. So once you've paid those other folks off, and if you were disciplined to pay them off, why don't you have that same discipline? And now let me pay myself. We just talked about paying yourself first. Well, if you couldn't pay yourself first, let's pay yourself now. So if you continue to invest, if you took the debt stacking plan, that $2720 each month, and did it, until you reach age 67 at a 9% rate of return, you could have about $2.4 million. Okay, this is not talking about paying yourself first. This is talking about taking the money that you're already paying to somebody else, and now let's pay that money to yourself. Let's now look. Let's be selfish now. Let's look out for self. We need more people doing that. A lot of times, once they paid off a debt, like I said, they take that money and they go somewhere else with it. Let's look at something called income protection. Income protection is, in this example, let's say you had a toaster in your kitchen, and on the 1st and the 15th of every month, $2,000 popped out of it. Would you like that toaster? Of course. Would you insure that toaster? You better believe it. I'd insure it. I'd make sure the kids couldn't get around it. And if people came in my house, they couldn't get near it. I'd protect that toaster, okay? Unfortunately, there's no such toaster. But most of the people on here, you are the money machine for your family. You're that toaster. And if it makes sense to insure an imaginary toaster, wouldn't it make more sense to insure your income? Okay, that's very important. We talk about insuring your income. So in this example right here, we have a husband and wife with a small child. They both make $3,500 a month. Their bills every month, you see they have a mortgage, they have cars, they have insurance, credit cards, groceries, childcare. What everybody else has is $7,000 a month. So they make $7,000, they spend $7,000. They're living paycheck to paycheck, okay? Now, if this happens, what will this family lose? All right, the bills are still $7,000 a month, but the income has been cut in half. What does this wife and the child do now? The mortgage company is still going to want their payment. Everybody's still going to want their payment. Nobody's going to say, okay, well, we'll just cut your payment in half. Doesn't work like that in the real world. So what do? We have to insure that income. We have to protect that income. Now, traditionally, it's called life insurance. It doesn't insure your life to prevent you from dying, but we like to say, let's protect your income with the insurance. All right, and that's what it's supposed to be about, protecting your income. So with life insurance, you have two options. First option is called cash value life insurance. It's known as whole life, universal life, variable universal life. They have all versions of it. But just in the generic whole life form, in this example, you've got John and Mary, age 35, and they each have $100,000 of insurance apiece. Their monthly premium is $225 a month. They also have cash value that's associated with the policy, where money builds up in the policy. And at age 65, they'll have $76,880. Okay. Now, just looking at that, that might not be too bad. They could say, hey, we're paying $225, but we've got $100,000 each. And when we get to age 65, we're going to have $76,880. That might not be a bad deal, but my saying is, compared to what? Okay. A philosophy that we believe in our company, which is called buy term and invest the difference. We believe that John and Mary, first of all, they're underinsured. They need at least $250,000 apiece. $250,000 apiece on the term insurance is only $80 a month. All right, so we've given them 2.5 times the amount of insurance for less than half the money. So with that same $225 they were spending, $80 are going to go for insurance, and now $145 that we saved them can now go to an investment. All right, so over that same period of time, at a 9% rate of return, they can have $265,457 at age 65. Okay, this is where compared to what? So looking at both those programs, which program would you want? And I think it's good that you have something to compare it to. Listening to one person, it can sound good, but hey, what else is out there? The same with the rule of 72. I thought 3%, 2% was the best I could do until I found out there was another option out there. You want to look at that. So a question that I get, because this is term insurance. Oh, term insurance is temporary. Well, term insurance can be 20 years, 30 years, 35 years, depending upon your situation. In this particular case, this is a 30-year term. We believe in term insurance because we believe in something called the theory of decreasing responsibility. And the theory of decreasing responsibility says that when you have young children, high debt, and a house mortgage, loss of income is devastating to the family. And I hope everybody would agree with that. Because in the early years, you need a lot of coverage, but you don't have a lot of money. So you make it through the early years, and now you get to the point where your children are grown. Your debts are lowered. Your mortgage is paid. Now you need retirement income. Okay, so you don't need to be protecting your income because your responsibilities have now decreased. What you need now is money to live on. We want to teach you how to build a living estate instead of an estate that's predicated upon somebody dying in order for you to get money. All right. So here's what's going to happen to everybody. You're either going to die too soon or you're going to live too long. One of those is going to happen. If you die too soon, you have enough insurance in place to protect your income so that your family can still maintain a certain standard of living. If you live too long and now your children are grown, debts are paid, mortgages paid, but you don't have enough money to live on, you're going to end up working the rest of your life. So dying too soon, living too long, we want to make sure both of those situations are covered. And that's what we do with our company. Now, here's the solution to all this, is that you need a financial house. And we talked about the financial needs analysis. And when we build your financial house, like any other house, you start with a foundation. The worst thing that can happen to you is that you die. You lose your income. Unless you're Elvis or Michael Jackson, where you have money coming after you die. Most of us are not in that situation. We need to protect our income. So the foundation of this financial game plan is to protect your income. And we suggest you do that by term insurance, because most people need 7 to 15 times their annual salary in insurance to make sure that their family can be taken care of. The next thing we want to do is a budget. You want to make sure you're living on a budget. You got your savings set up. You got an emergency fund, and you have a will. Didn't talk a lot about a will, but if you have property and you have minor children and you die without a will, you leave it up to the judge to decide what happens to your minor children and your property. You don't want to do that. You want to make sure you make that decision while you're alive. Then we talk about accelerating paying off debt. If you have debt, we want to put you in a debt stacking program, which doesn't cost you anything. It's just a matter of you being disciplined to follow the plan. Then we have retirement. Now, you'll notice that retirement comes before college savings. A lot of people say, well, I want to save for my kids' college. I want to make sure. That's great. But see, you can finance a college education. You can't finance a retirement. So we suggest that you make sure you've got your retirement on track and funded, and then go towards saving money for your kids' college. And then the last thing is your other goals and dreams. Vacations, philanthropic things you want to do. Those are the other things that's on the top of the house. So on a scale of 1 to 10, with 10 being the highest, how would you rate your desire to become properly protected, debt-free, and financially independent? That's the question that I leave with each and every one of you. And let me get my thing here. Here's my contact information. That's my picture and my contact information if you want to write that down. And if you want to get in contact with me about the ABLE account that we talked about earlier, or doing a financial needs analysis or something that I spoke on during this part of the presentation, I'm available to talk to you. Doesn't cost you anything to talk to me. I'm right here in Savannah. You've got my Primerica email. I got a couple ways you can reach out to me: phone, email, all those different ways that you can reach out to me. So, any
We'll
questions?
also have that information here at Life for anybody that can't see the screen or is on their mobile device that can't see it very well. We're happy to share that information with you as well. We've got it here at the Life Savannah office. So you could just give us a call.
Thank you. I appreciate that.
Sure.
So, are there any questions? I know that was a lot in a short period of time. I hope it was easy enough for you to digest it. But if anything, any questions that you may have had from what I just shared, from like I said, either the ABLE or my financial presentation.
Hey,
Yeah.
Daryl,
This
I've
is
got,
Calvin Tinley.
when you're done with him, I've got a call from James and I'll ask a question. Go ahead, Calvin.
Well, the thing that you mentioned about those, what do you call it, the stackable debt, when I bought the home in the Dreammaker program, a lot of the stuff you mentioned, they told me, and I was not laughing, but I was saying, look at here, somebody told me the same thing. But it was all about paying one bill at a time.
Mhm.
And what I did is I basically gave them a credit for the plan that you used. Basically, instead of living 1 month to 1 month, do 3 to 6 months, and then you basically live in 6 months free, because you give them the credit that they would charge you for the one bill. Let's just say $25, give them 100, whatever you can afford, and then that's 4 bills you don't have to pay. Then there's another situation where when I didn't have a light or a water or a utility, like you said, I doubled up on the mortgage. And that way the house was paid off in 5 years. But the plan you mentioned is an extremely beneficial, knowledgeable thing to have, because if you know, you do. If you don't know, you don't do. And I thank you for mentioning that, because I've been telling people that for years. Just get one at a time. When you can do two, do two. But the more you do, the better it is for you. So thank you. Thank you.
You're quite welcome. Thank you for amening that for me there. And I believe, and that's all part of financial literacy, to understand and to get some different strategies about how to manage your money, build your wealth, build your credit, and things of that nature. I mean, there's a lot to this. I just wanted to give a pretty much a high level overview and talk about some of the things that most people are dealing with when it comes to savings and investing, debt, life insurance, things of that nature. Everybody usually deals with that. So that's why I try to keep it pretty general, but thank you for that. And I'm glad that it worked out for you. You paid your house off extremely early. Congratulations.
Yeah, and
Yes,
there's so much information about what you're sharing today. It's a lot to take in. So I know people are going to have questions later on when they start to kind of consider these things. So James called in and he asked me this, Daryl. He said you did touch on how if you procrastinate, you emphasize what that scenario is. He has a different scenario that he wanted to propose, which is that if your income increases, is there a prudent way to kind of play catch up? Should you double up to kind of catch up? And is it possible to catch up?
It is. It's definitely possible to catch up. I mean, depending on what account you have. Let's say you're in you have a Roth IRA. A Roth IRA, if you're under 50, the max you can put in is $6,000 a year. And if you're over 50, it's $7,000. So if you've only been putting in $50 a month, that's only $600, and you've gotten a $100 a month increase. Now you might want to increase that because you still have some room to go in that particular plan. So you definitely can increase and catch up. What I suggest people do when they start investing, if they start at $50 a month, just automatically increase that every year by $10 or $15. Add inflation to that. So it should be an automatic bump up. You should if you start at 100, you shouldn't be 100 the whole time. You should be 100, 120, 130, 150. You want to continue to slowly walking up, especially if your income is increasing. Now, if your income is not increasing, then you need to keep it at a comfortable level, because I want you to at least continue to invest something than to have to stop it and not do anything at all.
Gotcha. Solid advice. Does anybody else have questions? I think everybody's pretty much really absorbing all the valuable information you shared today.
Yeah, it's a lot, but it's definitely doable, and everybody's situation is a little bit different. I just want to kind of give you a high level overview. But if you're interested in coming up with a plan for yourself, or just want to consult, just reach out to me and we can definitely do that. We can do it via Zoom or however you want to do it. With all this technology, it makes it a lot easier to reach out and communicate with people.
Is there a charge associated with meeting with you?
No, ma'am.
Okay.
Completely free.
One more question, Daryl.
Yes,
I
sir.
have a credit card that I just not purchased, but was awarded last year, and they were giving me 2% interest on my purchases, meaning I have a maximum limit on it, but the purchase, or every time I use it, there's a 2% interest on credit they give back for the use.
It's like a rewards card then. You talk about a reward?
Yes, it is. It's more or less every time I just pay $100, they give me $2 in interest back.
Right.
It's a 2% interest payment it's more like what's it called? An active cash credit card, where they pay me money for paying my bills with the card. And
They give you it's a rewards card. A lot of people are doing that.
Yes.
I was at Costco yesterday and actually got a Costco card, and their Costco card came with a 2% reward. If you got the credit card, there's another 2%. The whole thing behind it, they want you to spend money. That's what they want. They're hoping that you spend money and that you don't pay your balance in full in 30 days. You
Right.
see, they're going to make their money on, you're probably going to pay that 15, 16% interest on that. They don't mind
There
giving you
you go.
2%. If you're going to pay 15, they still win.
So
Okay,
what I
they're
do
not-
is every
they're not
time I
actually
pay
doing
the
anything
bill,
for you. Yeah, it's
Right.
almost a setup.
it is. But the trick is just like you're saying, just let them give you the 2% for paying your bill, and then before the date is due, you pay them theirs.
Yeah.
So
So
it's
credit
not a
cards,
big deal.
right. Credit cards aren't bad if you manage them properly. It's
There
just
you
that
go.
a lot of it's
That's it.
easy. It's easy to mismanage. I'm a big fan of using cash because when I pull in my pocket, I have to pull out that cash. I think about it. But to swipe that credit card, there's nothing associated with that. I don't see anything. But when I pull $20 out, $40 out, I'm kind of, do I really need that? And I'm kind of, maybe not. But that credit card, I'm gonna swipe that credit card. And, hey, I might even get you something if because I don't feel anything. And that's what gets
Right.
people caught up in the credit card trap because it's so easy to do.
Well, I like the way you put that, and the reason I'm laughing is because after paying all the, after you pay the bill, they give you rewards cash. So when you don't owe anybody and you've already paid them back what you owe them, what they try to do to keep you there is to give you more money. So that's what I'm saying. That's the catch. You got to give them theirs back before you can get more. But once you give them theirs, they'll always give you more. And that's the principle of your plan, to constantly, as you say, manage your money more effectively. And I thank you for giving us this presentation. And the more important part is a lot of the stuff you were mentioning, I did from experience through, I think they called it the Dream Maker program for purchasing a home. And it was done through the EOA Home Buyer Education. And I want to thank you for informing others, because I've been trying to tell people that for at least 13 years.
Wow.
Give them some of your money and they'll give you a lot more of theirs.
Appreciate that.
Thank you.
You're welcome, sir.